Hi, welcome to Conversations with Friends. I'm Brando. I'm a portfolio manager here at Navarre Capital, and with me is Bill Staten.
Brando, great to be with you again, as always.
Yeah, good to see you.
We have a lot of fun and hopefully help our clients make some money.
There you go. There you go. How you been?
It's been terrific. Just got back from 12 days in Canada, crossing it.
Did you have any problems getting back into the country?
By train and boat. Yeah, well, they let Mary in easily, but they always look suspicious. So they frisked me about 80 times.
Gotcha. Good deal.
But we made it.
Yeah.
We made it. It was fun.
Good. Well, we usually start these calls off with a cartoon or something kind of fun or interesting like that. And Bill, you may have known this, but this week is the 75th anniversary of Bugs Bunny coming out. I think the first cartoon was called That Wild Hare or something like that.
You know, Bugs Bunny and I are the same age.
Oh, really?
Yeah, 1947.
Oh, wow. I didn't know that. That's crazy.
Yep, that was his birth.
Did you watch a lot of Looney Tunes?
We were born at the same hospital in Eastern North Carolina. Bugs and I. We were in rooms adjoining one another.
Your rooms adjoining. Gotcha. Did you go on any of the adventures with Elmer Fudd and him?
Yeah, Elmer had the shotgun, and I tried to keep him from shooting bugs. Yeah, and I wanted to just launch just with one quote, Brando, and I think this is worth knowing. Earlier this year, one of the longtime money managers, many of you may not have heard of him, but his name was Fayez Seraphim, and he was, like us, a very, very long-term investor. And he had two quotes in particular I wanted to share with you. First of all, he said, "Nervous energy is a great destroyer of wealth." And the second one is, and we adhere to this 100%, we are owners of businesses rather than traders of stocks. And I think that's a good
100%
quotation to keep in mind.
Yeah.
And I just wanted to share that with our clients.
Yeah, no, that's a great reminder. 100%. Owners of businesses, not traders of stocks. So.
And I'd like to emphasize, we think they're terrific businesses, America's finest companies with rising annual dividends year after year after year.
So yeah, as we looked at addressing your concerns of inflation and recession, we thought it would be prudent to kind of look at the current inflationary environment. Recently, call it within the last 6-7 years, we've seen inflation's pretty much moderated somewhere around the 2.5%. And then as of recently, it's really skyrocketed, most recently getting above right around 9%. And looking back throughout history, there's really only one other time period that reflects this, and it was shocking as similar as the charts were when we were looking at it throughout time period.
They overlaid almost identically, Brando, when we looked at them. It was stunning, actually. Yeah,
and that's the period from 1967 to 1974. What you'll see is, same pattern. It kind of had a base level of inflation, and then it started to rise precipitously. We marked the chart with a star, and that shows the first peak. There was a second peak that was subsequent after that, but we'll talk about that here in a moment. And this is the interesting part, Bill, I think. And you remember the 70s. You were actually investing back then.
Yeah, sure was. My first horror show was the Great Bear Market, 1972 to 1974.
Is that what it was? Okay, yeah.
The Dow had just crossed 1,000 and hit a new all-time high before it subsequently dropped below 600.
Okay, yeah. So you're just reliving glory days, looking at some of these. Maybe not glory days. So
I tried to put it out of my mind, and now you're bringing it back.
Yeah, sorry. So, but you can totally attest to this. So I looked at the forward returns from 1974 moving forward, and it doesn't matter what time period you look, 1, 3, 5 years, that pretty much marked the bottom of when inflation had reached the peak. That was just a good time to get invested in the market because things were just so cheap.
Mm-hmm.
Right. And I just think that's interesting. What we found from 1974, that peak, is that inflation dropped the next few years. That was a good time for the market. But I think our investors are really concerned more in terms of risks and what's the downside, and how do we protect against that, which is really what our strategy has been focused on.
Yeah.
So as you kind of move forward throughout time, what you see is there's another rise in inflation, and it actually kind of peaked up above the 1974 peak, and that's shown on the chart as well. We have a chart here, so it's 1967 and 1980. In that rise in inflation, that's really what we kind of studied and focused on, because that time period, as a surprise, the returns were actually negative. So if you look at the S&P price performance or the Lehman Ag, so stocks and bonds were both negative similarly. The interesting point, and Bill, I'm sure you know this as well, but for our listeners, the interesting point is, even though the price return was negative for stocks, when you factor in dividends, it actually turned the performance positive for that time.
Yeah, dividends, even going back for 100 years, Brando, when you look at dividends, even through horror shows, the quality companies have been able to maintain their dividends.
Yeah.
At least, at the worst case, at least kept them flat.
Yeah.
So that when people invest in dividend growing companies, that gives them some income level going up every year, which is a positive.
Yeah, yeah. And it makes sense, right? Because
Yes.
if inflation is rising rapidly, bonds are going to get hit because you have a fixed income payment, right?
Right.
Stocks, the price performance of stocks should be going down because the discount rate is going to be going up, making the values smaller. The one component of that is the rising dividend is the real component that is able to combat rising inflation.
That's correct.
And so the way we want investors to think about this is, if inflation is growing at 7%, 8%, if we're able to grow the dividend at least 7 or 8%, we're at least keeping up with inflation.
Yes.
And that's one of the better alternatives that are going to be out there in the investing landscape in that type of environment.
Absolutely.
So the last point that we wanted to make was also in respect to the recessions, and we did a similar exercise. We kind of looked back. For this time period, though, we looked at 1965 to 1984. The chart we have shows inflation. Overall, the 20-year time period, you can look and you can pick and choose different performance metrics, but it was pretty positive for the general time frame, and a good time to invest. That time frame actually had 4 different recessions, right? And Bill, I think you and I have talked about this. A recession doesn't necessarily mean that it's going to be bad for stocks. Most of the time, stocks have already reflected that. Mm-hmm. And I think that's a little bit of what we've seen so far year to date is stocks are down, double digits in anticipation that the economic environment going forward is going to be rough.
Yeah, they're a discounting mechanism.
Exactly.
Yes, right.
Exactly. So to kind of just sum it up, I think we want to definitely encourage our investors to keep a long-term focus. Remind everybody that the market is forward-looking. There, when things feel the most, feels like the hardest to invest, it's already probably been baked in to the prices, and that's usually a buying opportunity to invest for your money going forward.
Yeah, when you're scared.
Exactly.
When you're
exactly.
scared.
And the last point is one of the best combaters of high inflation is going to be companies that can really raise their dividends and pay that out to shareholders. And we've had you and I, our discussions really have been focusing on trying to find those companies that are going to be able to do that.
Well, I just think that there's an extreme amount of bearishness right now. We know that among individuals, institutional investors, according to what I've read from several sources, they're percentage-wise they're right at record amounts of cash, which is a positive. They also have close to record amounts of bond allocations relative to stocks. So they're underinvested in stocks, let's say, which is a positive. They need to go the other way. So amidst all this negativism, it's time to be, I think, active and increasing equity exposure for a lot of people, particularly in the dividend-growing stocks like we have in our client portfolios. The company's continued to do well, as Brando and I have discussed umpteen times. Morningstar rating service is a service that we use quite a bit, and we have found in terms of their valuations of the companies that are in your portfolios, they have continued to upgrade a lot of the valuations so far this year. And the downgrades in valuations so far, even toward the end of July, have been very minimal. They might value a company formerly at $160 a share, and now they've reduced it to $157. So those have been very, very minimal, which we think is a positive. So overall, we think the worst is probably behind. Pessimism is rampant. Money conditions are not all that tight, and the Federal Reserve now looks like they have quit goosing the money supply, which ought to ultimately, not immediately, but drive inflation down, perhaps way, way down from what it is currently, and that will also be a positive.
Yeah, sounds good.
A lot of good to look forward to. We always like to close with something positive, and I wanted to read you a little bit from the Chinese philosopher Confucius. One of his most famous sayings was also the golden rule, which Jesus echoed: "Do unto others as you would have them do unto you." When asked whether there was one word that could guide a person through life, Confucius replied, "Reciprocity," which I thought was interesting. At 15, I set my heart on learning. At 30, I knew where I stood. At 40, I had no more doubts. At 50, I knew the will of heaven. At 60, my ears were attuned. And at 70, I followed my heart's desire without crossing the line. At each stage of life, he looked back on his own experience, and he reflected that every new chapter brings a new role to play and a new chance to grow. I love it.
Yeah, that's good. Yeah, very stoic.
Yeah.
So,
well, thank you all again for being with us. We hope what we've shared with you today has been helpful. And as always, Brando and I stand ready to help you with any of your questions or concerns. So please don't hesitate to email us. But even better, please call us, because we really do enjoy talking with you and listening to you and sharing with you. So thanks so much. Take care, and God bless.